In this section, I'm going to show you the basics of reading price charts. One of my favorite price charts that I like to use are the candlestick charts, and candlesticks come from ancient Japan when they used to trade rice. So it was rice traders, and it was a way for them to quantify price action visually. So as you can see here, you have a whole bunch of different green candles. You also have a variety of different red candles. Each one of these candle bars represents a different time frame and price. So as you can see up here in this corner, we've got all these different time frames. So right now I'm in the 12-hour time frame. When you see a green candle, it means that the price went higher. And when you see a red candle, it means that the price went lower. Now, if we were to break down one of these candles, you have, let's say on a red candle, for example, the main body right here would be the top, right? This is the open, and it means it closed right here on the main body, so closed right there. And this wick up here, this little wick, is the high, so that's how high it went. And this wick down here is the low. So that's a red candle. Open, high, low, close. And a green candle is pretty much the opposite, right? And sometimes you don't even have a wick. Like in this instant, you don't have one on the downside and you don't have one at the top. So let's look at this one over here that has a balance of the wick. So in a green candle, it means that it opened up lower than where it closed, right? So it opened up here, it had a low, maybe a little bit of a shakeout, and then it bounced, hit a high, and then finally settled down and closed right here. So when you have that followed by another green, it means that the direction has been moving up. So that's individual candlesticks. There's a few things you want to look at when reading price charts. Number one is you want to look at price action. So price action is the direction in which the price is going. So if you have a bunch of green candles, you know the direction is going up, and vice versa. If you've got a bunch of red candles, you know the direction is going down. You want to be able to identify areas of support and resistance. So support is where buyers step in, so you have multiple points of support right here. It came and tested, buyer stepped in, buyer stepped in, buyer stepped in. Resistance is where sellers step in and they push the price down, right? So it's whoever's in control of the market. When sellers are in control of the market goes down. So you can see there is some resistance here. When you break, and then the support and resistance in between these is a range. When you break out of that range, that's called a breakout, or when you break down from that range and go lower, that's called a breakdown. And so you also want to be able to look at momentum, right? Sometimes you can use momentum indicators, which we'll go into later for that. And then number two is volume. Volume is very important, right? Volume shows you how much action there is. I mean, you could get a whole bunch of different candles, but some of them might just be noise, right? So the candles that have really, really big volume show strong price direction, right? Strong action. There's usually the most volatility when there's volume. So these are all the volume candles down here, as you can see, right? And then you also have the prices here on the sides. And so you also have time and sales, so the live executed trades. So over on Coinigy, you just hit this tab right here. And these are the live executed trades right here. So you could see, how much Bitcoin people are buying and selling at any given point in time. And then you have the order book. And these are how much orders are stacked on the book, how much liquidity is on the books, right? Obviously, if you're going to trade on exchange, generally speaking, it's good to trade on exchanges that have liquidity. So you can see all the different orders and prices. So you can see here, someone's trying to buy, a little over 19 Bitcoins. You see them moving at that price, and it shows you the dollars right there. And so this is the bid side of the order book, and this is the ask side of the order book. So, if you're market making, you're stacking orders on the book. So you're putting orders on the book. And if you're market taking, you just immediately buy or sell into orders already on the book. So you market take if you really need to execute a position quickly. You market make if you're trying to get a better fill, either by buying or selling. And then the difference between the bid and the ask is called the spread, right? So the tighter the spread, the more liquid the market is. So as you can see here, there's a spread between 10.2407, 10.2481. So there's a difference here in the spread. Some exchanges have a huge gap in the spread. Some are much tighter. And obviously, the tighter you get to the spread, the better price you're going to have at executing or having your orders filled, right? So these are basically just all the different basics of the charts. And you also have time frames down here, right? So you see 2017, you can see different months. We're in February, different periods of the months. If you want to look at larger time frames, for example, you could look at a month chart, look at the entire picture, right? So each one of these candles would represent a month. So that's it for this section, and I'll see you in the next. Cheers.